Hey everyone, it's Rob, and it is December 4th, 2018, and the big news today in the markets was a big crash. The S&P, the Dow, and the Nasdaq all dropped about 3% on the day, and you can see that we were fine up until about lunchtime, and then it was a little bit of a bloodbath or just a really sharp drop here and just continued through the end of the day. And the key question is, what was causing the markets to crash today? I was a little bit surprised we saw the crash today, just coming off the strong retail numbers from Black Friday and Cyber Monday. Some estimates I saw were that we were up 9% year over year on those days, and that overall shopping was very healthy in November, and retailers had extended out the sales earlier in the month. So overall, it looks like the seasonal shopping period had started off very strongly, and I thought that that would give a little, if it happened, it would give a big boost to the markets heading into the end of the year, and then 2019 may be where we would see the beginning of the true recession. That was kind of where I thought we were going, but we had the big sell-off today, and I'm going to explain why that happened. We had the beginning of a Treasury yield curve inversion today. The 3-year was trading at a higher rate than the 5-year for the first time, and typically 7 out of the last 8 recessions have been predicted by a Treasury yield curve inversion. Now, typically it's the 2 and 10-year rates and not the 3 and 5-year rates. And on the 2 and 10-year, we're still not quite there yet. We're really close, though. We're at 0.21% difference in the spread between the 10-year and the 2-year Treasury yields, and we've been going that way pretty much since it looks like about 2013, 2014. And this year we have drifted down to get really, really close to where that's inverting. But we haven't quite done it yet, but I think the algorithms that are doing a lot of the trading nowadays in the stock market are looking at the 3 and 5-year as an indicator that the U.S. markets may be starting to downturn, or there's negative news and the markets may downturn, so the selling started today. I think it was back late August, maybe early September, when I talked about a global yield curve inversion. There was some data had come out that globally the 2 and 10-year overall debt had inverted, but it hadn't happened quite in the U.S. And I thought that that was an early predictor that the world was going into a recession, but the U.S. wasn't quite there yet. Now, however, we have a shorter term rate in the U.S., a 3-year inverting with the 5-year, and that could be indicating that the 2 and 10-year, which is the one people really follow in those bond markets, is about to invert and could invert this year, may invert Q1 of 2019. We'll see. That's definitely been the trend now for several years. So that's something to keep an eye on, and that's probably a big reason why the markets are trading down today and lost so many points. Another reason is weakness in the banking stocks. This is something I've talked about recently. We're looking here at the SPDR S&P Regional Banking ETF, and you can see year to date how this is down. Looks like about 7.2% on the year, so 2018 has been a bad year for a lot of the banking stocks. I did a video recently looking at 2 other banking indexes, and they were both down as well. So the banks aren't looking very good. The financials aren't looking good for 2018 so far. There's some weakness there after having some strength in the 3, 5, and 10-year trends. So it looks like there's trouble in the financial sector. Of course, a lot of that's probably driven by the increasing bond rates and the expense that puts into the market for financing. And here's a nice chart from CNBC that looks at some of the banks taking a bruising. Citigroup is down 22.8% last 52 weeks year over year. Morgan Stanley 27%, Bank of America 18% down, 10% on JP Morgan, 22% on Regions, 21% on SunTrust, 28 on Citizens, and 20 on Capital One. And then Tuesday's change, you can see there's a lot of carnage in the banking stocks in one day. It really looks like the financial market's kind of taking a beating right now, and that's not a healthy indicator for a healthy economy going forward. So that is sort of another canary in the coal mine, if you will, of a downtrend in the U.S. market. This is something I've been talking about pretty much all of 2018, predicting that would probably occur sometime at the end of 2018, maybe 2019. It looks like we're starting to get into the first stages of that recession so far in 2018, and I expect that to continue into 2019. Although I was a little surprised it happened today because of the sales numbers in retail. But honestly, the yield curve inversion and the banking stock news is probably much worse than the boost that we would get from the good prints in the holiday sales numbers. So that's where we are with the stock markets. That's why they're down. And we'll see what happens for the rest of December. If we continue to have good retail sales, maybe that'll perk up a little bit. We'll see if the yield curve steadies a little bit. Really pay attention to the 2 and 10-year. If that one inverts, that could be a very strong sell signal. And if the algos see that I mean, if we saw a 3% drop in the markets at the point where the 3 and 5 year are inverting, imagine what's going to happen when the 2 and 10 year yield invert. There's going to be a lot of computerized selling at that point. I'm sure that's already built into the programs. And once one of these algorithms kicks off, a lot of them start to kick off. They see, not only do they see these numbers or these indicators in the markets, but they'll also see a sell-off in the market. So once a sell-off begins, it just sort of piles on top of each other. And it'll be interesting to see if all the circuit breakers built into the markets really kick off and stop that selling, and whether they'll have to close down the markets or close down certain sectors or certain specific stocks with those circuit breakers. And we'll see if that's really going to halt a recession. Hasn't really so far yet. In 2018, we've seen some pretty big drops. But I know from watching some of the financial news programs, the circuit breakers have kicked in at certain times during the year. So we'll see how much protection that offers investors. But I would be very cautious in the markets right now. I would definitely look at re-examining your positions, maybe putting some money in some safe havens, and just protecting yourself from a risk-based perspective. Don't put everything into speculative stocks or volatile sectors if you're, with these signals showing that maybe the economy is starting to turn down and we may be heading into that recession that I've been talking about for the last few months. That'll do it for today, guys. Thank you very much. If you like this video, please comment below and subscribe. Until next time, this is Rob.